Hello, and welcome to our third quarter Market Insights webinar. In the following material, we will share results with you about what happened in the capital markets, both traditional and alternatives. Certainly, it's been quite the fascinating quarter with a volatile August and its recoveries in September and October. We have Fed action to talk about, as well as various trends in the equity markets and alternative markets. We hope it is a good use of your time as you listen to this webinar. I'm Greg Leonberger, the Director of Research here at Marquette. In today's webinar, you'll hear from the following analysts at our firm. Jeff Hoffmeyer will talk about the U.S. economy. Ben Moore will discuss fixed income. Samantha Grant will cover U.S. equities. David Hernandez will talk about non-U.S. equities. Brett Graffi will discuss private equity. Joe McGuane will discuss hedge funds. And Jeremy Zirin will talk about real estate and infrastructure. Our agenda follows the same agenda we've covered on previous webinars. We start by talking about the U.S. economy because that is a natural backdrop to capital markets. We then move on to traditional investments consisting of fixed income, U.S. equity, and non-U.S. equity. Then we move to alternative investments, real estate, infrastructure, private equity, and hedge funds. The webinar consists of about 40 minutes of prepared comments, and at the end we'll discuss how you can submit any type of questions you have about the material on today's webinar.
Hi, I'm Jeff Hoffmeyer, and I'll be covering the U.S. economy. The trade war continues to be one of the many geopolitical concerns facing the economy, and while there was enough of an agreement between the two countries for the Trump administration to cancel the increased tariffs originally planned to take place earlier this month, there is still much to be negotiated, and additional tariffs are still scheduled to be implemented on December 15th. Despite this back and forth between the U.S. and China, year-to-date worldwide trade for the U.S. remains mostly unchanged from 2018. As we can see, both imports and exports are flat. What has changed is the decline in trade directly with China, notably about a 12.5% decrease in exports from them. Other countries, such as Mexico and Vietnam, have benefited as many businesses have moved their operations there. So while China remains the largest exporter to the U.S., this suggests that the U.S. may be less reliant on Chinese goods and can handle a sustained trade conflict. With that said, that doesn't mean there has been no effect on the U.S. economy or that businesses are not cutting back. This is especially true in the manufacturing sector. The PMI index, which surveys these manufacturers, fell to its lowest point in over 3 years, and the index is now below 50, suggesting that the sector is contracting. Manufacturers surveyed additionally conveyed that slowing global demand was also hurting their businesses. This slowing global growth, the trade war, and other economic concerns have weighed heavily on overall business sentiment, which has steadily declined during the year and has resulted in business investments falling off. Consumer confidence, on the other hand, remains stable as these ongoing issues haven't impacted people on an individual level. Of course, consumers are often the last to know when the economic tide is turning, and if they lower their spending, economic growth could fall negative. Because of all these concerns, the odds of a recession occurring in the next year has spiked over the last several months and is now at about a 35% chance based on predictions by the New York Fed. This metric uses the shape of the yield curve, and because of its recent inversions, an economic downturn is much more likely. While it is possible that this time is different, this measure has historically been an accurate predictor. Another sign that a recession is coming soon is the prolonged low unemployment. On average, recessions occur about 41 months after the headline unemployment rate falls below the natural rate of unemployment, a measure which essentially removes any cyclicality of aggregate demand. When unemployment is below this rate, it suggests the labor market is overheated and due for a correction. This quarter we surpassed the 41-month average, implying a downturn is likely on the horizon. To counter this slowing growth and hopefully fight off a recession, the Fed reversed course this past quarter by cutting rates in July and again in September. The Fed futures market is anticipating that they are not done and that at least another 1 to 2 cuts will happen through March's meeting. While markets reacted positively to this news, the effect of these cuts may be limited given the prolonged low rates just a few years ago, as well as negative interest rates in some parts of the world. Finally, looking at some of the main economic highlights, GDP grew 2% in the second quarter and is expected to expand 1.8% in 3Q. Unemployment remains low and inflation continues to be near the Fed's target. Overall, while fundamentals are mostly stable, there are several factors that could cause turbulence in the economy. These include the impeachment proceedings against Trump, the 2020 elections, slower global growth, and the increasing prevalence of negative rates, all of which could lead to trouble ahead. With that, I'd like to thank you all for listening, and next up will be fixed income.
Hi, I'm Ben Moore, Markets Director of Fixed Income. The biggest event in the quarter was the brief inversion of the 2-year U.S. Treasury yield over the 10-year U.S. Treasury yield during a few days in August. In addition, the entire German yield curve fell negative, as did the front half of the Japanese yield curve. All of this has been attributed to the persistent global slowdown that we've been experiencing over the last decade, driven in large part by the world's aging demographic. While the front quarter of the U.S. yield curve is inverted, the back 3 quarters is still upward sloped. However, the yield curve may no longer be a reliable recession barometer because much of the Treasury purchasing has been coming from yield-seeking German and Japanese pensions, in addition to the flight to safety caused by strained U.S.-China trade talks. The 10-year fell from 2% to 1.68% in the quarter, boding well for duration as the AG returned 8.5% year-to-date. Bank loans returned 6.4% year-to-date, high yield returned 11.4% year-to-date, and emerging markets debt returned 13% year-to-date. The negative yields in Japan and Germany may continue to drive foreign yield seeking into U.S. bonds, driving up bond prices in the short term. However, in the longer term, go-forward rates may be lower, and investors may have to add more duration, more lower credit quality yield, more diversified fixed income, and/or more equity beta to reach return targets. Just before both the 2008 housing and 2000 tech crises, the 2s 10s and 2s 30s both inverted, while today the 2s 30s has not inverted at all yet. While the recent 2s 10s inversion is a concern, part of it has been driven by yield reaching from Japanese and German investors who are mostly buying longer U.S. Treasuries, so our inverted yield curve currently may have a bit of a false signal within it. This and the fact that the 2s 30s is still upward sloping represent a weak signal for an impending recession and a strong argument for continuing to hold credit, which is yielding a strong 6% average across bank loans, high yield, and EMD. Currently, Fed funds futures are projecting a 60% plus probability of another 25 basis point cut at the October 30th meeting, and a 60% plus probability of yet another 25 basis point cut at the January 29th, 2020 meeting. As such, maintaining a moderate duration positioning is recommended to take advantage of the accretion to bond returns in the short term. Mortgage-backed securities are showing some deterioration. Recently, there was a notable uptick in new consumer foreclosures and bankruptcies, but even then, it's still only at 05 to 06 levels, not yet at 07 to 08 levels. Foreclosures and bankruptcies are showing a weak but worsening signal for an impending recession. Asset-backed securities are showing some deterioration as well. We're seeing upticks in serious consumer delinquencies at 90-plus days across student loans, credit cards, and auto loans, roughly at 05 to 06 levels, not yet at 07 to 08 levels, but getting there. However, serious delinquencies for mortgages and home equity are still very low and benign at 04 to 05 levels. Spreads widened to near long-term averages in the fourth quarter of 2018 dislocation. From January through April in 2019, they tightened back to tighter than halfway between long-term averages and all-time tights. But in May, with the risk-off sentiment from the trade war, spreads again widened to near long-term averages, showing value, while in June they tightened in somewhat, but still showing some value. In July, they continued to tighten, driven by hopeful trade talks, but the deterioration at the end of the month, culminating in Trump's additional tariff announcement, along with Argentina's populist primaries vote, widened spreads in August. In September, bank loan spreads widened out slightly as the odds of 3 to 4 more rate cuts rose to 70%, while high yield spreads tightened in slightly as the trade talks resumed. Bank loan use of proceeds towards acquisitions and LBOs has been hovering around a peak of 60% over the last year, right around where it was just before the 2008 crisis. Through the Great Recovery, it dropped to a trough of 30% and has now risen to concerning highs. However, much of that has been due to the shift from high-yield issuance to bank loans, as high-yield use of proceeds towards acquisitions and LBOs remains low at around 20% today, well below the 50% where it was just before the 2008 crisis. There is potential frothiness in the bank loan market, but the high-yield market is relatively benign, at least from the issuer's risk-taking perspective. However, high-yield spreads are near all-time tights, at just 100 basis points away from the tights just before the 2008 crisis, while bank loan spreads are still roughly at long-term averages, nowhere near the tights just before the 2008 crisis. Thus, corporate credit fundamentals are showing moderate to cautious valuations, with still some runway left. While the Argentine presidential election on October 27th is expected to go to the populist Fernandez-Kirchner camp, much of this has been priced into the emerging markets debt markets. However, such an election result may increase the chances of an Argentine default on their sovereign bonds, which may not have been fully priced into the market yet. We expect continued volatility in this asset class. To summarize, for core bonds, duration continues to provide principal protection in market corrections. There is growing deterioration in both consumer and corporate fundamentals. For bank loans and high yield, fundamentals are still moderate on the balance. For emerging markets debt, pro-business Macri's impending loss to populist Fernandez in the October 27th Argentine election may have largely been priced into the markets, but further spread widening cannot be ruled out. This is an idiosyncratic market dynamic, however. For overall emerging markets debt fundamentals, they still remain favorable. This concludes the fixed income section of this webinar. Thank you for listening. The next section will be U.S. equities.
Hi everyone, I'm Samantha Grant, and I'll be covering the U.S. equities section. It was a volatile quarter for domestic equity markets as a weakening global environment and trade issues came front and center again. The S&P 500 finished the quarter up, albeit a paltry 1.7%, which masked volatility. The index was down over 5% at its lowest point in the quarter. Overall, the stock market has been pretty resilient through it all, declining earnings, trade wars, etc. Year to date, returns still hover above 20%, and I'm sure many investors wouldn't mind closing up shop now as the last quarter is historically tricky. All in all, not too much has changed from the summer. Year to date, large cap stocks hold a 7% lead over their smaller cap brethren, and growth leads value by approximately 5%. One trick that we saw over the quarter was a rebound in value. At the end of August, there was almost a 10% difference in the performance between value and growth for the year. This was the widest spread seen since 2009. But what goes up must come down, and there was a huge resurgence in value over September. The rebound lasted only 10 days, yet was strong enough to make value a winner for the month. Many called for the resurgence of value, but we are more cautious. Typical value rebounds are sustained for months and not days, so we will have more conviction once the relative outperformance of value is more consistent. Growth, momentum, and low volatility are the leading factors in 2019. And sector performance mirrored factor performance. Representing the growth factor, the technology sector returned 31.7% year-to-date, and low volatility bond proxy sectors of real estate, utilities, and consumer staples had the next best returns, which range from 22 to 29%. As a result, valuations have continued to rise despite low earnings and slowing growth. The S&P 500's 18 times valuation is still off its 21 times 2017 high, but it's still elevated. If equity markets were to rise much more without a subsequent rebound in earnings, we would be more cautious on future returns. One area that does look attractive on a relative basis is smaller cap stocks, particularly small cap value. Larger cap indices hit new highs this past July, but the small cap indices have been underwater for more than a year. The Russell 2000 and microcap indices are well into correction territory. Declining earnings, shrinking profit margins, lower interest rates have weighed on smaller cap stocks. However, like value, we remain cautious on future outsized returns and/or a strong rebound. And it does not look like the political class will pull us out of this melee anytime soon with current impeachment investigations in the House. We reviewed the performance of the markets during impeachment proceedings and could not make any definitive conclusions because, one, there have not been many impeachment proceedings, so the sample size is small, and two, market returns during the Nixon investigation was driven by a recession fueled by high inflation and an oil crisis, while the Clinton returns were driven by the dot-com bubble. So it looks like the future of the U.S. equity market depends on you and me, better known as the resilient U.S. consumer. Retail sales in the orange has continued to increase over the past year. On the other hand, S&P 500 earnings, which represent the private sector in the purple, and manufacturing activity in the green have been declining. We can only wait to see if the consumer follows. To echo my colleagues, slowing growth, whether through the trade war with China, declining interest rates, lower business investment and earnings, or a weaker consumer are risks to future U.S. equity returns. However, equities remain attractive relative to their lower yielding fixed income peers. We will continue to monitor these risks and be prudent regarding any tactical recommendations. Thank you for listening. Next, I'll pass it off to David to cover non-U.S. equity.
Hello everyone, my name is David Hernandez, Senior Research Analyst at Marquette Associates, and I will be covering non-U.S. equity section. Most non-U.S. equity benchmarks rebounded in September, but still produced a negative return for the third quarter. Year-to-date performance, however, remains in positive territory, with developed markets up 12.8% and emerging markets up 5.9%. These returns have come despite a significant drop in earnings and economic momentum throughout the globe. In the coming charts, we will talk about these two trends further. Now, additionally, geopolitical risks remain elevated, creating higher levels of investor uncertainty. One event responsible for investor uncertainty is the Brexit. It's been over 3 years since the Brits voted to leave the EU, and markets are still unsure how and when this event will conclude. Over this 3-year time period, the British pound has moved up and moved down as investors try and measure the probability of a hard Brexit, which would be an unfavorable outcome. In mid-October, UK and EU leaders Boris Johnson and Jean-Claude Juncker agreed to a new Brexit deal. Earlier this week, the UK Parliament approved that deal, but voted against the October 31st timetable. They wanted to add 3 more months and extend it out. The Prime Minister, Boris Johnson, is adamant about leaving on Halloween. Later this week, EU leaders will decide whether to allow the extension into January. So what does this mean for the Brexit? It means more uncertainty and more drama to unfold. In general, investors and businesses tend to dislike uncertainty. A company that is unsure of future trade relationships between the EU and the UK, or U.S. and China, for example, are likely to cut future investment plans. We are already seeing this play out, and it has contributed to a drop in economic activity, here measured by the Purchasing Managers' Index. Over the last 2 years, this economic indicator has fallen globally, with regions like UK and the Eurozone breaking the 50 level, which is a sign of contraction. As a result, we've seen global GDP forecasts come down. In 2017, we're in an environment with strong economic momentum, and we saw GDP forecasts increase through the year, moving from 3.2% to 3.6%. Now, with economic momentum losing steam, forecasts have fallen from 3.7% in 2018 to 3.2% in 2019. Central banks throughout the world have been paying attention, and as a result have become more accommodative over the last 12 months. We've already discussed the Fed's interest rate cuts and plans to cut in the near future. The European Central Bank has also made some cuts of its own. It recently shaved 10 basis points to its key rate, now at negative 50 basis points. The ECB also announced that it's going to resume its bond purchase program of 20 billion euros a month starting in November of this year. Now, this dovish trend is not just happening in developed markets. You look at countries like China, Mexico, Russia, Turkey, Brazil, Indonesia, and the Philippines. Each of these countries have employed rate cuts this year. So central banks are supportive, and this is a current positive for equity markets. A negative for equity markets has been the slower earnings in 2019. Globally, earnings growth is expected to end the year flat as analysts have revised expectations downward through much of this year. Emerging markets have particularly come under pressure, now expecting negative earnings growth. So the positive equity returns that we've seen have largely been driven by multiple expansion rather than earnings growth. Looking forward, 2020 expectations remain relatively high, between 6 to 12% across the globe. Any deterioration in those forecasts could lead to a very tough year for equity investors. In summary, equity returns have been positive for the year despite weak economic and earnings momentum. Multiple expansion has been the primary driver of returns. Central banks throughout the world have become more accommodative and more supportive. We are cautious on return prospects the rest of the year given the poor earnings and economic environment and relatively high earnings expectations for 2020. With that, I want to thank you for listening. Next up are hedge funds.
Hello, I'm Joe McGuane and I'll be reviewing hedge funds today. Hedge funds finished the quarter mixed as equity markets experienced a fierce sector and factor rotation. Equity hedge strategies ended the quarter lower as managers focused on tech and healthcare struggled to generate upside during the quarter. Event-driven strategies struggled as idiosyncratic negative events led to a performance drag. Macro had a strong quarter as some managers were able to navigate a choppy market environment with gains from equity and currency trading. Despite the rotation of growth versus value during the quarter, managers are still positioned with a bias toward growth-oriented sectors. This chart shows the companies in the S&P 500 index by quintiles from highest to lowest short interest. Short interest is a market sentiment indicator that tells whether investors think a stock's price is likely to fall. When short interest is high, it implies investors believe shares will fall. During the third quarter, positive alpha generation was observed with the majority coming in the month of September. Healthcare, technology, and biotechs provided the most short alpha during the quarter. Going into the fourth quarter, net exposure remains lower compared to this time last year, as managers expect more volatility going into year-end. This chart shows the performance of Goldman's portfolio of favorite hedge fund picks, which draws from over 800 hedge fund managers. The popular holdings in hedge funds were positively correlated with growth and momentum, which underperformed during the third quarter. Crowded FANG and software stocks were the main culprit for the underperformance from top hedge fund holdings. The top 50 stocks in this index are heavily weighted towards infotech, consumer services, healthcare, and financials. In the third quarter of 2018, hedge funds began buying shares of this California public utility on the view that the utility's 2017 fire liability would be much lower than expected. On January 29th of this year, PG&E filed for bankruptcy related to more than $30 billion in liabilities related to wildfires in 2017 and 2018. In August of this year, PG&E bankruptcy judge allowed a civil trial to move forward related to the Tubbs fire, the second worst wildfire in California history, causing the equity to sell off aggressively while the bonds experienced very little pressure following this ruling. Despite this sell-off in the equity, distressed hedge funds remain invested with the view that the equity will recover over time. Last year, hedge funds were observed making bullish bets on Argentina debt with the view that the country would not default on its debt. These bets proved punishing after the country's pro-business president, Macri, had a disappointing showing in a primary election. That set markets tied to Argentina into turmoil because the outcome indicated he may lose re-election. Argentina debt traded to distressed levels following the primary results on the view that the new administration would likely default on their debt. Hedge fund managers believe the debt will recover and the new administration headed by Fernandez will continue to pay its creditors. And finally, September was the worst month for total alpha from equity hedge managers since 2010. Value and momentum factors were the main cause of alpha pain during the month. Crowded hedge fund longs underperformed broad markets, and something to watch going into year-end. And to wrap up, gross and net leverage fell across strategies going into year-end. And with that, we'll pass it off to private equity. Thank you.
Hi everyone, I'm research analyst Brett Graffey, and I'll be covering private equity today. Highlighting private equity returns, it is important to note that private equity returns are lagged, and we are examining quarter one performance, but the return trends we saw earlier in the year continue to persist today. Private equity returns underperformed public equities in Q1 of 2019, with the U.S. private equity index returning 5% as compared to the Russell 2000 returning 14.6%. However, this underperformance follows a year where private equity significantly outperformed public equities in 2018 as the U.S. private equity index increased by 10.7%, exceeding the Russell 2000 index, which declined by 11%. These performance swings highlight the strong, consistent returns and lower volatility profile investors have grown to expect from private equity. Overall, private equity continues to reward investors with outperformance as compared to other asset classes over a longer-term horizon, and investors continue to increase over allocations as they search for higher return opportunities. Significant private equity outperformance in 2018 has diminished as public markets rebounded in quarter one from their quarter four 2018 pullback, but overall median industry returns remain attractive with significant outperformance provided by the upper half of industry funds. Recent vintage year private equity performance should continue to separate from public markets, much like from 2011 to 2014 funds have, as operational improvements materialize and companies are sold off efficiently within a competitive exit environment. LP demand for private market alternatives continues to drive a strong private equity fundraising environment, with fundraising up year to date over 2019 and on pace to surpass 2018 as larger funds continue to be raised. The large end of the market continues to pull up fund sizes as the top 10 funds have raised over $80 billion, or 25% more than the top 10 funds raised during the same period in 2018. Fundraising and average size were both boosted in 2019 by the largest buyout fund ever in Blackstone's $26 billion BCP8 and the largest tech buyout fund ever in Vista's $16 billion Fund 7. We expect this momentum to continue in Q4. The market has remained a seller's market in 2019 as GPs continue to take advantage of elevated transaction multiples and have now exited over 700 companies in 2019. However, the investment activity in 2019 continues to remain modest as most GPs remain disciplined in the face of high transaction multiples and positioning investment activity for an annual decline. The private equity industry continues to be responsible for a growing percentage of overall transaction volume, now nearing 40% of transactions. Corporate strategic acquirers haven't been as willing to compete for transactions as aggressively in this higher price environment. Investors continue to allocate a large amount of capital into the industry's largest fund managers with proven platforms. These funds have been a great solution for large investors, allowing them to both increase their allocations into the private equity market while reducing their overall number of manager relationships. Dry powder continues to remain elevated due to strong fundraising, particularly for larger funds over $1 billion in size. We expect this dry powder to continue to weigh on returns at the larger end of the market as these funds compete for deployment and support elevated multiples. The disconnect between public and private market valuations continues to widen. Within private markets, valuations within transactions less than 100 million enterprise value remain 25% below the middle market. We continue to believe the most attractive area of the private equity market is within small funds focused on taking advantage of the persistent inefficiency of small companies. These funds have the ability to significantly grow and improve a business and exit in a more efficient process at higher multiples. Key takeaways. Global private equity fundraising remains strong with the continued growth of funds raising $1 billion or more and robust investor demand for the asset class. These dynamics, coupled with the current level of dry powder, will continue to lead to greater competition for assets. Private equity remains an expanding, attractive asset class with lower valuation multiples relative to public equities.
Hi, I'm Jeremy Zarin, Senior Research Analyst, Real Assets, and today we're going to be talking about real estate and infrastructure, but first we'll start with real estate. Preliminary core real estate returns delivered a 1.3% return for the third quarter. Year to date and on a one-year basis, returns are 3.7% and 5.5% respectively. While 3Q19 returns are slightly higher from the second quarter, which was 1%, real estate returns continue to moderate. In the third quarter, managers continue to experience write-downs in the retail portfolios, as well as write-downs from new legislation around rent controls in states such as New York and California. More on that later. The retail sector continued to be challenged in the third quarter, with managers experiencing write-downs in their mall portfolio. Big box retail centers and regional malls are experiencing the brunt of these write-downs as a result of lower rental growth prospects and high capital expenditures. This is being exacerbated by company bankruptcy filings, particularly in the apparel sector. This chart shows that retail same-store NOI growth has decelerated significantly since 2013 compared to the overall NCREIF property index, as store closings and capital expenditures accelerates within the retail sector. Retail strip center same-store NOI growth is stabilized at 2%, while mall same-store NOI growth is at negative 1.1% year over year. Another key reason for depreciation this quarter and in 2019 has been attributed to new rent control laws. To date, Oregon, New York, and California have all passed statewide rent control laws, which mainly limit annual rent increases between 5% and 7% after inflation. 4 more states, including Washington, Colorado, Illinois, and Massachusetts, are on the watch list for potential rent control initiatives. One of the reasons for this is because national wage growth is lagging rent increases. Since 2008, in the downturn, annual growth in multifamily rent has greatly outpaced median household income. The widening gap has occurred over decades, making it especially hard for entry-level and middle-income earners to buy homes. Affordable housing legislation is a top priority among 2020 Democratic presidential candidates, and we believe more policy on rent controls and workforce and low-income housing is likely. This chart shows the historical and current spreads between core real estate cap rates for major property sectors against the 10-year U.S. Treasury yield. Despite a mature real estate market with little to no appreciation, the spread between cap rates and the 10-year Treasury yield reversed course in 2019 and continued to widen based on preliminary 3Q19 data and as a result of lower U.S. interest rates. Today, real estate cap rates represent a premium to fixed income, and the wide spread provides a nice buffer in the event that interest rates do go up. In summary, we would expect total returns for core real estate in the mid-single digits with an emphasis on NOI growth over appreciation. Also, we expect interest rates in the U.S. to continue to fall, which should provide a premium and healthy buffer to fixed income. In terms of themes, the retail sector continues to deteriorate, leading to write-downs, particularly among regional malls, and rent controls in states such as New York and California may continue to negatively impact the apartment sector. Moving on to infrastructure. Dry powder remains extremely high and has jumped to $209 billion in the third quarter of 2019. In terms of fundraising, unlisted infrastructure fundraising has been slower in 2019 compared to the record fundraising year in 2018. Between the first quarter and third quarter of 2019, infrastructure funds have secured just 67% of the capital raised in the same time period last year. This is most notable in the third quarter of this year, with only $8.4 billion in capital raised versus $44 billion in the third quarter of last year. The number of deals through the third quarter is slightly down from last year, but still remains robust. You can see from this chart that the number of deals in North America and Europe has slowed down relative to last quarter, whereas deals in Asia have picked up. The growing middle class in Asia is a key factor to this, especially in China and India, where urbanization is rapidly increasing, resulting in heightened demand for essential services. This chart shows the historical core infrastructure discount rates, represented by the dark blue line at the top, and the infrastructure equity risk premium, represented by the light blue diamonds, versus developed market bond yields at the bottom. Based on current private core infrastructure discount rates, private core infrastructure is expected to provide a 7.4% risk premium in 2019. Even as discount rates for private infrastructure have declined in connection with global bond yields, the equity risk premium in private infrastructure has remained stable, averaging 7.2% since 2000. Greater investor interest in private infrastructure assets is driving the discount rate lower. However, the decline is lower than the decline in global government bond yields, resulting in private infrastructure risk premium increasing. As most global central banks are in the midst of a cutting cycle, this trend is likely to continue, attracting greater interest from investors. This chart looks at the historical income and capital appreciation of private core infrastructure based on the MSCI Global Infrastructure Index. Private core infrastructure as an asset class has provided a total return of 11.1% per year, with 5.2% of income since 2009 based on the index. We anticipate the asset class to continue to provide investors with a high cash yield. As a large proportion of infrastructure assets receive their revenues from contracts or serve a regulated market, their income or distributions are generally relatively stable. In summary, the need for global infrastructure investments continues to persist, and institutional interest in the sector continues to rise as investors are seeking diversification, attractive risk-adjusted returns, and stable cash yields. All of these factors, and with the fear of rising inflation and interest rates subsided, are positive for the asset class and should provide tailwinds to the sector.
Thank you for spending some time with us today on this webinar. You heard about what happened in the fixed income markets, particularly about what the Fed has done and plans to do in the coming months. We talked about U.S. equities and non-U.S. equities, particularly what we saw in the third quarter, as well as what to watch for the remainder of 2019. For alternatives, we discussed hedge funds, private equity, real estate, and infrastructure. In conclusion, we hope it's been a good use of your time and you have some useful comments to bring back to your committees. If there are questions about any of the material, please feel free to reach out to your consultant and he or she can obtain follow-up answers. Additionally, there's an email shown on this screen. You can email any questions to this address and you will receive a response about your questions. To wrap up, please share any feedback you have about this webinar. We strive to make these a good use of your time and we're always looking to improve them. So if there are any suggestions you have, please share them. If you are so moved, subscribe to our channel for quarterly insights videos. You can also register for any research email alerts on our website. We'd like to thank you for watching. We hope to see you next time. Thank you.